Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
Help, I have a property insurance claim. Yes, that's a book. It's also a problem. But we have an expert, and it's the author, Karl Hechavarria. And he is the author of this book. And he is he's quite an agreeable man, even though he deals in property insurance. And I don't know how you can be so agreeable, Karl, because it's a big problem. And people never know where to turn. And when I saw your book, I said, oh, my, that's going to be absolutely perfect for people because it's a small book, but it has all the answers in it.
Yes, I try to cover most of the situations that people are in day to day, once you're a homeowner, a condo owner, or a renter. And
and you did. And how long did it take you to write that book?
Probably about nearly a year, actually.
And what made you decide to do that? I know you've been in the business for a long time.
Yeah.
Why that was quite an undertaking.
Well, over my 28 years in the insurance industry, I found that a lot of people they're not sure what they're entitled to. They don't know what to do once they have a claim, how to go about it. So I decided perhaps they need some help. So I attacked the most prevalent type of claims and decided to write a book to help the insureds.
And so what would you say, of all the claims that people have had problems with, what is the most common? A roof blows off in a hurricane?
Well, in Florida, that would be, yes. But I think they're more theft claims than anything else.
Theft claims?
Yeah, theft claims, yeah.
Oh, and how do you prove that?
Well, first of all, if you can keep your documents, receipts and so on and so forth, but people get rid of them. They don't normally keep them. But another thing you could do is to videotape your home. You have cell phones, you have videotapes. Open your drawers, your jewelry drawers, walk around the house and videotape everything. And then keep that tape off premises because if there's a fire loss, the tape burns. And there goes your proof. There are other things you can do to prove your own items like receipts, manuals, operator manuals, not brochures. Now, that's the important difference because a brochure tells you what the features of the item, whereas a manual will tell you how the item operates. Because someone can just go to a store, take a brochure and says, hey, I had this item and it's stolen.
But that's right. But a manual has to be inside the product.
Exactly. And it's specific to that product. It tells you the operation, what you can do, and so on and so forth.
That's very clever. Okay. Well, that's a good start. So we're going to talk about theft and that's that you said that's the most common.
Yes, statistically, break and enter or thefts off premises.
How about losses of those kinds of things? Somebody has it, but they can't find it.
Well, there is a classification called mysterious disappearance.
Oh, mysterious disappearance. Now,
okay. Not all policies cover that. But what that does, it's a disappearance of an item with a known time frame from a known place. For example, the insured goes to a wedding and she puts on an expensive necklace. She doesn't normally wear it often, so she goes, and when she gets home, it's late in the morning, she just throws it down. A couple of days later, she wants to put it away, and all of a sudden it's missing. Now, where did I put this thing? There's a big search, it's not found, and that's called mysterious disappearance. Now, there may be some intervening factors. For example, the adjuster will ask, where did you put it last? Well, I left it at the top of my bureau or whatever the case may be. Has any strangers been in the house? Workmen, construction men? And if they say, oh, yes, we had a couple guys come in, fix the carpeting, blah, 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 then there could be a strong presumption of theft. So it moves from a mysterious disappearance to a presumption of theft. And in that case, with some supporting documentation, that claim is paid.
Oh, that's very clever because it's funny that I have a wedding ring, and sometimes it's a little bit too tight to my finger if I've been sweating or if I'm working and I take it off.
Right.
And I usually always put it back in the same place. But there have been occasions where I haven't. I was doing something else, I put it there. and I can't find my wedding ring. And I panic. And I keep looking around, and that's what I always wind up finding it. But that would be the kind of thing you're talking about, right?
That's correct. Now, another thing is, most policies, they have a sub-limit on jewelry. For example, $2,000. Now, if you have jewelry that's in excess of that amount, then you can schedule it, which means you actually insuring it separately, and you pay an extra premium, so that you're not limited that $2,000 maximum payment. And that scheduling includes mysterious disappearance, which you normally may or may not have on your basic policy.
I see. That's clever. But now, the thing, though, isn't it better for someone to know you? I mean, do you do this now? Are you in insurance now that someone would come to you?
I retired recently.
You retired?
Yeah.
Okay, so that's too bad, because now you know everything. But that's good, so that's why you put it in a book.
Right.
So when someone goes to buy insurance, they should really have someone like you were, experienced enough and smart enough to be able to tell people and describe that policy, because most people don't know what they're signing.
That's true, but if you're going through a broker, he or she should explain to you exactly what the coverage is. They should review the policies, because, for example, you may want a policy that's not very expensive, so you don't get the full coverage you need. So the broker will say, well, this is a policy, but this one covers more. And you can decide how much you can afford for the premium, and you better get a better coverage.
I see. That's a very good idea. All right. Well, let's get rid of some personal theft that way. Let's talk about actual property damage.
Right.
Let's talk about, as I said, and I think I may have mentioned it in our article, Karl's book we featured as a publisher's choice in our October issue, because I felt it was very important. And it's called Help, I Have a Property Insurance Claim. And it's Karl Hechavarria, and his name is spelled Hechavarria. And this book is really, I would think it would be a godsend for people, because there's so much in it. It's hard to really describe it all, but I think especially for people down here in South Florida with the weather, of course now out in California with the weather, with the fires, I mean, it's just, unfortunately, I do believe in global warming, and I can see it everywhere, but I just think that you have to have property insurance. And, of course, if you don't have a mortgage, no one makes you have it. But
That's
it would
right.
be stupid if you don't. And then as a renter, you don't have to have it, I guess. But unless you have the person who owns the property, let's see. A renter's insurance is only for your own personal things, isn't it?
That's correct, yes.
But you did talk about that in your book, about if you're in a condominium, some things the condominium has to take care of and some you have. Why don't you explain that? That's very important.
Okay. Basically, the condominium, look at the building. That's the actual structure. That's the building, and that's covered by a master policy. And that policy covers damage to the building itself. Now, the condominium owner, the policy covers just your contents. It does not cover the building. The master policy does that. So, for example, if we have let's say we have a hurricane, and the condominium damage the roof and so on and so forth, then the master policy takes care of that. But if your contents are not damaged by the hurricane, then of course there's no claim. But if you do have damage, water comes in, your furniture is stained, carpet wet, then you would present the claim under your own personal policy. Now, sometimes there's an overlap, and if there's any dispute, the master policy pays first, and then the unit owner's policy pays second.
Now, I'm renting, so I have a renter's policy.
Right.
And I don't really know what that's for. Actually, I took it because the owner of the apartment wanted me to have it.
Yeah, well,
Tell me about that.
What that does, the renter's policy, actually, again, it covers your personal property. But more importantly, let's say you have a leak in your apartment, and it goes to the second floor, the low floor, and it damages the apartment below you. Then you could be liable depending on what caused the flooding. And the renters on the liability section would reimburse the person whose apartment is damaged below you. And because sometimes I've had seen pipes broken on the 15th floor, and it goes all the way down to the basement.
Well, that's a funny thing you should mention. We're home last night. Just happened. And all of a sudden we hear a pounding on our front door. And that was very unusual. And I was a little hesitant even to go, although we have a condominium complex where there's a guard and all.
All right.
And when I opened up the door, there were two men who were in service in, what would look like uniforms,
Right.
service uniforms. And they said there is a leak somewhere, and we have to check if it's coming from you. And they had to pull our refrigerator out, and there was no water. There was nothing. They asked if we had any water.
Right.
So they're trying to track where the leak is coming from. It's exactly what you just said.
Exactly.
Thank goodness it wasn't from us.
And one of the reasons they're tracking it is if the leak is caused by the negligence of a unit owner, then you're liable for all damages in your apartment and all the ones below you. But if it's not your fault, for example, a rusted pipe, then there'd be no liability attached to you.
That'd be the master policy,
That's
wouldn't
right,
it?
right. Because
Yeah.
you're not obliged to tear up the walls to inspect your pipes, basically.
Yeah. Oh, I see. It's now. Let's go back to the weather problems. There's something that I've seen that said this isn't covered if it's a flood, or wind, or there's certain things that aren't covered in an insurance policy.
Right. Well, the two major perils. The peril is what causes the loss. The two major perils that does not cover is flood and earthquakes. The reason for that is that it would bankrupt an insurance company if they covered floods. For example, the San Francisco earthquake in 1989, it cost the insurance industry $5 billion.
That's a lot in 1909.
That's right. In 1994, where we had the Northwest earthquake in Los Angeles, that was $42 billion. Katrina was $81 billion. Andrew in 1992 was $15.5 billion. Now, as you know, we have flooding going on in North Carolina and
South Carolina,
yeah,
right.
And this, from what I can understand, this is not just a 1 in 100-year occurrence. It's a 1 in 1,000-year occurrence. That means statistically, there's no actuary that can predict the damage that will eventually cost the insurance industry. Now, the offset of that is it affects everyone's policy. Most insurance companies will reinsure their risks. For example, if the insurance company has, say, assets or, well, for example, Citizens, they have $7 billion in reserves to pay claims.
Citizens, that's right. When I owned a house, we had to have Citizens because we were on the ocean. So they had to take places that were risky.
Yeah,
right.
It's called insurance of last resort. Actually,
Okay, last resort.
You can't
right.
get coverage
and it's
elsewhere.
expensive too.
Oh, well, because the risk is much higher. So what happens when an insurance company, if they have reserves of, let's say, $10 billion, and they insure an area, and the loss comes to $15 billion, of course, that company goes bankrupt. In the interim, what they'll do is they'll go out and have other reinsurers say, okay, we'll take a piece of the action, we'll take a piece of the action. So for example, to use round numbers, if you're paying $1,000 in your premium, then the other companies say, okay, I'll take 25%. So of that $1,000, $250 goes to another reinsurer. So in other words, when there is a claim, proportionately, the reinsurers and the insurers get together and pay the claim.
Oh, that's the way to keep it going. Otherwise, they'd have no insurance companies. You have to do that.
In the San Francisco earthquake back in 1909, whatever it was, there was a company who literally went bankrupt. But what they did, they paid a portion of the claim to everybody, and they gave them shares in the company. And then over the next 25 years, they bought them back until that person was fully reimbursed.
Now, that was really wonderful. I mean, now that was real responsible, and they didn't bankrupt, right?
I think that's the first and last time we saw that.
Well, okay, so now we're really talking about a lot of things that we know something's going to happen. Now my question is, so let's just say that when we did have a hurricane, and
right.
we had, and I remember we had some damage, and it was on a carport just made of canvas, and so they asked us, when we put it on, when we first built it,
Right.
and then I guess they depreciated the time, but we thought they should pay us to have another one done and whatever that would cost. But I don't think it worked that way.
Well, it depends on the structure. If the structure was, concrete and
No, it wasn't.
then that they don't depreciate. But if you have something that will, over time, depreciate if a canvas stop or the case may be, then yes, you get the depreciated value.
That's right. And so they gave us money, but we couldn't really put that back on again.
No. That's a depreciated value, which happens in some structures.
But I guess it depends which hat you're wearing. Is it the insurer's hat or the other person?
Yeah.
But of course, I've had other kind of experience. We've had some commercial property, and we've had problems with. They're very careful before they insure the property insurance. They want to make sure that everything's in perfect order. And if not, you have to list it, whether it's the roof or the parking lot or whatever it is. So I was very, very attracted to your book because I've had a lot of insurance things happen. Once the insurance company says that's what it is, it's very hard to go then and try to get more money. I mean, they're pretty.
Well, they have some routes you can take. For example, if there's a dispute as to the value of a home or piece of jewelry or some item in your house, you have what is called an appraisal, which means you will get somebody at your expense to value that piece of property. The insurance company will also get a similar person, and the insurance company pays that person, and then there's an umpire. Now, the two appraisers will argue about the value, and if they both agree, then it's settled for that amount. If the two appraisers fail to come to an agreement, then the umpire steps in.
It's like arbitration, right?
Right, exactly. And if he takes the side of appraiser A or B, once you have 2-1, then that's the amount you'll get.
Okay, so do you have advice for people when they're going, and let's say, I think the most easy thing to talk about would be you have a home and you want to put insurance on it.
Right.
All right. Do you have any advice as to what people should be looking for when they do it? I mean, the policies, you could put a lot more money on it than you do it. I guess you have a budget, and you can say, well, I can only afford $300 a year. I mean, what do you advise people?
Well, you have two options when selecting a policy. One is called ACV, and one is called replacement cost. Now, the ACV policy, ACV meaning actual cash value, that policy is much cheaper. And I'll give an example. If you have a watch, and you paid $100 for the watch, and for some reason the watch is stolen and you have to replace it, and the insurance company says, well, you have an actual cash value policy, which means that watch which you paid $100 for is now worth $50. So it's the replacement cost less depreciation, and that's what you'll get. Contrary to the replacement cost policy, where if the watch is $100, it's now $150, you'll get $150 because you get your replacement cost of the thing that was lost. And that's the key, because if you have a lot of expensive stuff and you have ACV and you have a serious fire loss, then you're going to be out of pocket a lot of money, as opposed to having the replacement cost, which will reimburse you 100% to replace that item.
Now, it is more expensive, I can just tell right now.
Oh, yes, it is.
It's more expensive.
Oh, yes,
so I guess you have to decide, is it like going to a casino, and is it kind of gambling to figure out, well, something could have happened to this? Is it worth it or not? I mean, how do you think about it?
Yeah, you have to give careful thought as to how much of a loss can you take personally. In other words, do you have the money to replace the items, and if you don't, then it's worth your while paying a little extra to get that comfort to know that you'll be reimbursed in full. Now, another thing that most insurers don't know about is sublimits. There's sublimits for stamps, jewelry, and some other items, exotic paintings, coins. And if you have a coin collection, for example, let's say $10,000 and it's lost, but your sublimit in the policy is only $2,000, that's all you're going to get. But the option you have is, I mentioned before, scheduling. You can say to the insurance company, well, I want to schedule or insure my stamp collection or my coin collection for the full value, $10,000. So you'll pay a little more for that scheduling, but then if it's lost or stolen, you'll get the full amount as opposed to taking a loss.
Okay, but I was excuse me, I just had a gentleman on who works with life insurance.
Right.
And so that's the same thing. You're paying on it and paying on it and paying on it. And, of course, some people can't afford it anymore, and they drop it. But all those years that they've paid on it, they're gone.
Money goes down the drain.
So is there in life insurance, when you pay a certain amount, then there's money that you can borrow back from it. But that's like a whole policy.
That's a whole life policy.
Yeah, that's not what. Nothing happens with the rental. Nothing happens. With property insurance, is it? You just have to pay it, and every year you pay it again, and you pay it again,
that's
right?
And once you stop paying, then there's no insurance, unfortunately.
Yeah, and that's. I will tell you something that just happened too, which I actually moved from this property. We were renting a property, and it was just 400 square feet. It was just a small little property for our office.
Right.
And he required and it was in a building that had maybe 10 little offices and different things on the first level. It was just like a little shopping center.
Right.
But it was not new. It was, it was an okay condition, but it wasn't. I'd say it's probably between a B and C building.
Okay.
And he required, and I saw it, I didn't pay attention to it. It was in the lease when I took it. And I didn't really pay attention. And he wanted to have, I think, a $2 million liability policy. And I had to go, I did get one from a very good company, and I think it cost me about $350 or $400, maybe $350 for the year. You start adding that up on your rental, it added more money. I thought that was I didn't think that was fair. And I only stayed there 2 years, and I did move to another place. What do you think about these something like that, liability? What was that? What did he? Oh, I know, it's personal liability. He was afraid if someone came in and got hurt, they would go back to him. And is that the way it works?
Yeah. Yes. It's unusual because normally someone who has a complex like that would have a blanket policy covering all his personal liabilities, but he obviously shifted that to the tenant.
Right.
And I guess if the tenants agree to pay,
well, that's it. I'd never rented something like that before, and I didn't look at it carefully enough.
Well, the problem is if he insured the entire complex and someone got hurt, let's say someone went to buy something and tripped and broke an arm and whatever the case may be, then his policy will respond. But what he did in that case is pass that liability on to you, the unit owner, and say, you have to protect me, basically. So if there's a problem, then...
all right, so let's say, for example, I love having you on the show. This is like getting all... Do you have anything else to say before I ask all my questions?
Oh, no, just try them.
Oh, okay, because I have so many questions to ask you.
Please
okay.
go ahead, go ahead.
All right, so let's say that someone did fall or something did happen, and I had a policy for $1 million, whatever it was, liability. What if the problem was their $4 million because they wanted to sue, or I don't know, someone fell down into the ditch and they broke their head open and they died? Are they going to come after me?
Yes, you would be. You would be on the hook if you're liable. Now, don't people think that once you fall on someone's property, the property owner is immediately at fault? That's not quite true. You have to prove that the owner of that property was negligent in some way. They had some carpeting that was not anchored, so the person slipped on the carpeting, or if in the case of we have snow, that the owner didn't shovel the snow in time, so therefore you slip and fell.
Or in some cases outside there are holes that weren't filled in, and so on. Exactly.
Their ankle and stuff like that.
And even though it's not my property, that person, would they sue the owner of that?
They would probably sue the owner of the unit plus the building owner. Plus, if the building owner had a contract with a contractor to immediately repair potholes and the contractor didn't, then he could also pass some of the liability on to the contractor for not fulfilling his contract. Or if you had a contract to shovel snow, and the person who the snow contractor didn't shovel in time, the snow stopped falling. 2 days later, he hasn't shown up yet. Then you could probably also include him in the liability because he was negligent in not performing the snow shoveling as agreed ASAP.
Thank goodness, Carl, we don't have snow. We have hurricanes and floods, but not snow. Thank
one
goodness.
less thing to worry about.
I'm talking with our author, Karl Hechavarria, who is the author of Help, I Have a Property Insurance Claim. And the book is not expensive, but I have to tell you, but you can buy it for $15, $14.99. And let me tell you how you would get it. You would go to his website, which is mylossclaimpaid.com. mylossclaimpaid.com. I would think everyone should buy this book because it's it's very easily to understand everything in it. We all have to have insurance. I mean, it's like there are very few things that we have to have, but I think we have to have insurance for just the things we've been talking about. And you can have an inexpensive policy, and maybe it'll take care of you. But I've always been very confused. When I get an insurance policy, I just talk to the person I'm getting with. I never read it. I sign it because it's too complicated.
It is. It's a very complex legal document with a lot of riders and exceptions and exclusions and what have you. One thing, though, that's quite important, and this about 10 years ago, it started getting popular. It becomes popular every year, and that's that host liquor liability.
What is it?
Host liquor liability. If you give a party for your friends, and you have
host liquor liability. I thought I've heard you, but never heard of this before. Host liquor liability. All right, what is that about?
Here's an example. You have a party, and you have an open bar, and there's alcohol, and no one is monitoring it. So this guest of yours drinks, he's impaired. He's on the way home driving, and he strikes and kills someone. You could be liable
oh my heavens
for that accident because you did not monitor the amount of drinks that this person had, and you could be included in that liability. So I would suggest that you have someone designated to either pour the drinks and say, hey, this guy had too many, or observe the person, bloodshot eyes, staggering around, slurred speech, and you say, you cannot drive home, and I'm going to take your keys.
Oh, my heavens. That's really amazing. Well, that was so good. So, listen, Karl, this has been a great show. I mean, sometimes people say, what could you talk about with something like this? I said, oh, there's so many things. We'll have you back again, though. I can tell you right now because we have to have you back again. Thank you so much. Be sure to buy this book. It's $14.99, and it's on his website, mylossclaimpaid.com. Thank you again, Karl.
Oh, you're quite welcome. My pleasure.